All right, so today we're going to talk about what makes a bank run. So, a little bit of background on me. Currently, I work at First Southern National Bank, and I've been with them a little over a year and a half. And I've worked in various roles. Started out as an intern, worked in that role for about 6 months to 8 months, something like that. Went through the daily operations, learned every side of the banking field, and kind of got a general overview of what it takes to be a banker. And then I moved recently into the role of a teller. So that's your transactional stuff, your deposits. Everybody knows what that is. And then most recently, I got promoted into a loan support role, which is assisting loan officers in their day to day. So that's a little bit of background on me. And now I'm going to share about what it takes to run a bank effectively. Okay, so a bank has two major components. Obviously, you have your deposits and you have your loans. Your deposits are your day-to-day customers bringing in their money to deposit in the bank, and your loans are your bank taking out those deposits that are coming in from customers and giving those out to other customers so they can use them for their daily needs as well. And here's just a picture of the logo of the bank that I work for currently. So deposits. Deposits keep the bank's lights on. So that's a sentence that sounds a little weird. It sounds a little tricky, but it's very true. So your deposits keep the bank's lights on. Your loans are what makes the bank money. Your deposits are what keeps the bank's lights on, keeps the operations going. Your deposits build a bank's operating capital. So your deposits build your baseline for your bank. So the more deposits you have, the more baseline cash you have. And the more baseline cash you have, that's going to allow you to invest freely. So your banks, like people and like other companies, they invest in things. They invest in companies. They invest in stocks. And then also your deposits are going to allow the banks to hire more team members. And with more team members hired, that comes more locations. And with more locations should produce more profits. And here on this slide, I have a general overview of what a bank deposit looks like. So here we have Mr. X. He's depositing money into the bank. And that deposit could either be in a checking, a savings, or a money market account. And we'll get into what those different types are a little bit later. Deposits. There are many different types of deposits. Like I just said, we have a savings, a checking, and a money market account. Your savings accounts are mainly used for people that are wanting to put some money away, either to save it for a big purchase or just want to put it away so they don't really touch it. Majority of your money should be in a savings account versus your checking. Okay, moving on to checking accounts. So your checking accounts are your money you put in the bank for spending purposes, your day-to-day things. You go to McDonald's, you get a coffee, you pay your rent. That's your checking account. You have money in there to spend. And then your money market accounts, that's very different from your checking and savings. So you have your CDs and your treasury bills. That's the two probably most popular, especially in the bank I work at, for investing purposes. And that's what I was wanting to get at here, is your money market accounts are mainly used for investing. So a CD, for example, could have a rate of a 2% return for a year-long CD. So that means if I put in $10,000, at the end of the year, I'll make $200 off that investment. That's a CD. All right, moving on. We'll now discuss loans. So loans are what makes the bank the most money. Now that's done in a variety of different ways. That's with loan growth, loan production, net loan value, your fees, your interest rates, all those different types of things make the bank the most money. Your loans are created from loan officers, naturally. A loan officer has many different duties. Some are more commercial based, some are more consumer. If you're more of a commercial loan officer and in a business world, you're going to go out and knock on doors, try to churn up business, whether that be with a cold call, warm call. You're going to go and try to see if you can't churn up something to get some loans. Loans charge an interest rate. So loans aren't free. You can't just go in a bank and say, hey, I want $10,000, and they're just going to give it to you. No, it doesn't work like that. Loans do charge an interest rate. Those rates are variable. They change, and some are fixed. So if I went into a bank today and needed to take out a loan for a mortgage, you're going to look at somewhere between 6 and 7%. Most loans are either consumer or commercial. So a consumer loan, it's very simple. It's me, myself, I'm walking into a bank. I need a loan for a truck, and that's a consumer loan. Commercial loan, on the other hand, that is me going in as a business entity, going in to take out a loan for my business purposes. That's a commercial loan. And here we have a diagram. It's called How to Get a Bank Loan. I don't know if you can read it or not, but here we go. So first step is you build and understand your credit. Now, building credit is a tricky thing that some people don't have a clue how to do. You build credit either by having a credit card, taking out loans, but the main thing is paying them off timely and on time. That will build your credit higher. And the higher credit score you have, the better interest rate you'll get, and sometimes the lesser fees you'll get. Step 2 of getting a bank loan is settling on the right loan amount. That would be done with the loan officer. Step 3, decide on the type of loan. It could be a closed-end fully AM. It could be a fixed rate. It could be a variable. There's very many different types of loans you can choose from, all depending on your payment and your payment structure. And then you'll want to understand and budget for the loan. This is important. Okay, this is all about repaying the loan to the bank, which every borrower will do in time. If you don't budget for it, you might not have the cash available to pay it. You'll see some 30, 60, 90-day late fees and things like that you really want to avoid. And then the last 5 and 6 steps are you apply and then you go through the underwriting. All right, moving on. Continued. Like I said, there are many different types of loans. The most popular that I see normally is an installment loan. That's your fixed rate, fixed payment. Every single month is going to be exactly the same payment. The borrower knows exactly what to expect. Commercial loan. Now, like I was saying, a commercial loan is usually a business loan, but here in this aspect, with an IGL code of commercial, that means it could be a variable rate. It's not going to be the same payment every month, and that's all going to depend on interest rate. You have something called a line of credit. So if I was operating a business and I decided to draw out a line of credit, that's basically me having, let's say I have a $50,000 line of credit with First Southern National Bank. So I go in as a business, I apply, I get the loan. 2 weeks later, I'm building a house. I need $20,000 for materials. I can go in and draw $20,000 from that line of credit. It's not a lump sum you're getting at the first day of the loan. You can go in and draw on it whenever you need it. And then your variable rates and fixed rates, pretty self-explanatory. Variable rate on a loan is going to change time to time. Fixed rate's not. It's going to stay the same. All right, who makes a bank run? So this is very broad here, but banks have a designated person for each job within day-to-day operations. So you have your tellers, customer service, loan support, loan officers, branch managers, and community presidents. So very briefly, a teller is your day-to-day deposit operations specialist. They're taking in deposits, they're taking in savings accounts. Somebody comes in, they want to withdraw from their checking, they're doing that. They're doing the day-to-day stuff on the front line. Your customer service. So the customer service person is taking care of any issues that a customer may have when they walk in the bank. They're taking care of any problems that may arise. Your loan support, their day-to-day job every day is meeting the needs of the loan officer. Usually they're designated to a specific loan officer, and they're taking care of getting credit pulled, getting documents signed, all the grunt work behind a loan, the loan support takes care of. Your loan officers. So your loan officer is the one that's going out, churning up business. They're really in charge of making the bank money. And that can be done. Sometimes it's sitting behind the desk and answering phone calls, and other times it's going out and knocking on doors. Your branch manager. Your branch manager is in charge of the deposit side, so that's your customer service and your tellers. And then your community president is in charge of everybody. So they're making sure everybody's doing their day-to-day just like they need to. All right, the power of team. So first I want to highlight this picture I have here. T-E-A-M, team. T, together. E, everyone. A, achieves, and M is more. Together, everyone achieves more. Okay, that's real important. It takes each person committing to the task at hand for a bank to operate smoothly. If one person throws a chink in the armor, it's not going to work correctly. One spoke falls off the wheel, it's not going to work correctly. The same thing is the same in a bank, okay? There is no I in team, okay? Clearly it spells it, T-E-A-M, team. There's no I. So it's not all about me, me, me. It's about us. It's about we. It's about the team. And without teamwork, nothing would get accomplished. Not a day-to-day operation, not a loan, not a deposit. Nothing would operate smoothly. Problems banks face today, okay? 3 big problems, and then we'll get into them a little deeper. The interest rate crisis, okay, number 1. Number 2, high turnover of employees. And number 3, which I think is most important and most prominent in most banks and other industries as well, is your lack of motivation. okay? And here on this right side, we have a diagram of the interest rates and how they've changed from 2020 up until today. You've seen low points, you've seen high points. It seems like we've hit the ceiling for it, but who knows with the Fed and how they operate, okay? Moving on to the interest rate crisis. Interest rates are rising fast. This is partly due to inflation. This is partly due to demand. And the big question that all banks are asking and all consumers are asking is how high are they going to go? Where are they going to go in the future? What are they going to look like tomorrow? And unfortunately, that's a question that we don't have the answer to yet. Employee turnover. Okay, 3 big things in this factor. Workers today are always looking for the next opportunity. Tying in with that, they have this mindset of the grass is always greener. You have that mindset, you're thinking, well, I can make more money at this job if I job hop around and find something else. And I believe that this idea stems from the instant gratification culture in our generation today. I know my generation today, we're all about our phones, technology. On our phones, you can look something up, get it just like that. It's very simple and it's instant gratification. The same thing carries over to employee turnover, and the workforce as a whole. All right, lack of motivation. This is a big deal and it's affecting everybody, okay? High amounts of laziness in society and culture today. Now, that might step on some people's toes, but that's just how it is. People are lazy. They don't want to work. They're lazy. They don't want to work, okay? COVID-19 caused people to become dependent and passive, okay? COVID locked people in their houses, and it allowed people not to have to really try for their income, okay? They were getting, not only were some people getting their income checks, they were also getting the checks from the government, $2,000 and $3,000 all the time. And that caused people to become a little lazy, in my opinion. Okay? The industry of banking as a whole is not as cutthroat as it used to be. Okay? People are a little bit more passive, a little bit more scared to say things that are necessary on their mind, a little bit more hands-off about things. And that kind of creates a lack of motivation, creates a lack of desire to go out and earn it, in my opinion. And here on this next diagram, we have an image of somebody laying down at their desk asleep. And that pretty much describes our society as a whole today. All right, banking yesterday. Banks used to not be a popular place. Okay, this stemmed from people not trusting banks or financial institutions with their money. The run on banks happened, all that history of banking in that sense. Okay, this stemmed from not only being able to trust the bank off their word. This was pre-FDIC insurance. So if a bank got robbed and I had $100 in it and that $100 was taken, I wouldn't see it again 50, 60 years ago. Things have changed since then. Every operation required for a bank to run was done in-house banking yesterday. Okay, these tasks range from printing checks, human resources, to lending. Every operation happened in-house. Nothing was outsourced. Banking today. Banks today have new technologies emerging almost daily. I see this in my workplace, and I've heard other colleagues in other banks say this as well. Okay, there's things like CSI NewPoint, Salesforce, nCino, and ITM machines. Now that's probably way over most people's head, but that's new technology that's emerged in the past 2 to 3 years that didn't exist 10 years ago. Okay, banking has become more automated and more transactional than ever before. Okay, this means that people are, just like I said earlier, that instant gratification society, banking online, things like that. You're doing it easy and quick. You don't have to go in face to face necessarily to even get a loan these days. Now, in my mind, I think that banks that maintain that personal touch with their customers will rise above their competition today and in the future. Keeping that personal touch is key. And here on this side, we have an image of Chase Bank, and they have their ITM machines out. And if you notice here, you have 1 customer and 0 employees. I think that's a sign of things to come. Whether that's a good or bad thing, I'm not sure. All right, getting towards the end here. Banking tomorrow. 5 or 10 years from now, banking will most likely look completely different. You're going to have higher technology, more automation. That comes with that instant gratification society that we have today, and less face-to-face contact. And that stemmed a lot from COVID-19 and that pandemic and being stuck at home, not being able to be face-to-face in a safe manner. And on this side here, we have the future of talent in digital banking. So it's almost like a spider web here. Everything is connected. So you have your debit card connected to the internet, connected to social media. Everything's going to be connected. this could be a good or bad thing as well. Who knows? And thank you for having a great semester, and appreciate your time listening to my presentation on banking. Thank you.